All right, everyone, well, welcome to this video today where I'll be showing you about the bond market and how investors are looking at the yield curve to understand if the US economy is going through growth or contraction. And today it's signaling the deepest recession in the United States since 1981. And this is going to predict that stocks are likely to go lower if history repeats itself. Investors use the bond market to understand if the expectations for economic growth are positive or negative, because that's how they position themselves in the stock markets based on the bond market's predictions. And the bond market gets it right 90% of the time throughout history. Central banks look at it, professional traders look at the bond market, and I'm gonna show you how to interpret it for yourself so you can get ahead of the curve and make sure that your position in the market is in the right direction based on the expectations for what's coming. I'll show you last year when the Federal Reserve was raising interest rates, just how perfectly correlated the 10-year government bond yield, so the interest rate on the 10-year government bond, was to the performance of the S&P 500. And if you can use the yield curve inversion or upward sloping for growth or contraction alongside a 10-year government bond yield going up or down, you will literally know the direction of a stock market, whether that's the NASDAQ, S&P 500, the Dow Jones, it doesn't matter. This controls all of the markets. All right, so watch this video. I really hope it adds some value. If you like the video, please like, comment, and subscribe to my YouTube channel. And hopefully this does help you with your trading. All right, everyone. So we're going to look at the bond market and how the bond market currently is telling us that there's a deep recession coming in the United States and why the stock markets may crash, as banks like Morgan Stanley are saying stocks can go down 20% if the bond market is correct. And the bond market does predict recessions going throughout history. So the bond market recession signal is getting louder. Here is a report that came out yesterday. You can see in Yahoo Finance, the bond yield inversion has reached its deepest level since 1981. So what is it telling us? So basically the bond market inversion is the yield curve, and the curve of the yields basically just means the interest rates on different government bonds over different time periods, and what are those interest rates over different time periods telling us about the economy. So remember, you can borrow money to a government over a 1 month period, 3 month period, 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, up to 30 years. Now the interest rate attached on those different maturities, when I say maturities, I mean different bonds over specific periods of time. So the interest rate currently in the United States on a 2-year government bond is 5%, but the interest rate on a 10-year bond is 3.96%. So why do different bonds that mature in different time periods have different interest rates? And the reason is because it's an indication of where the markets are expecting the economy to go. So are they expecting economic growth, or are they expecting an economic contraction? And right now the market is signaling they're expecting a contraction, because in a normal environment, when you look at this blue line, and this is looking at September 2011, you can see at that time interest rates were at 0 coming out of the financial crash. But over the different maturities, the further you borrowed money to the US government, so over 5 to 7 to 10 to 20 year period, you could see the interest rate over the longer term was more expensive for the government to borrow money over a 20-year period compared to borrowing money over a 2-year period. So why is that? Because in an environment of economic growth, there is inflation. And if an investor is going to borrow money to the US government, then they want to make sure that they're going to get enough interest to protect them from inflation. Now, central banks, economists can only forecast inflation out to like 2-3 years. That's what their forecasts have. Once you get to 5 years to 10 years, the truth is no one really knows where inflation is going to be over that period of time. So if an investor borrows money to a government over 10 years, they want to have a premium interest rate on that bond to make sure that they're protected from the unknown level of inflation. So in a normal environment with normal economic growth, you have an upward sloping yield curve indicating that there's going to be inflation and economic growth. Okay? And in times where the markets get fearful of a recession, well, what ends up actually happening is that you get an inversion of the yield curve. And if the yield curve is sloping downwards, this is basically telling you that investors are predicting there's going to be a recession in the economy. So what we can see currently is, if we look at March the 5th, 2023, which is when I'm recording this video, this is March the 9th. So this yield curve is for this week. We can see the yield curve is inverting. So for an example, a 2-year government bond is paying more interest than a 10-year government bond. So why are investors not demanding higher interest if they borrow money to the US government over a 10-year period than if they borrow money to the government over a 2-year period? Compared to down here, when we saw that investors were demanding a much higher interest paid by the government to borrow money over a 10-year period compared to a 2-year period. Because in this time in 2011, the economy was growing, there was inflation, so investors were demanding higher interest to compensate them from inflation. At this moment in time, the markets are not betting on inflation, they're betting on a recession. And a recession is basically when the economy is going to contract, and we all know why that's happening, because right now the US Central Bank is raising interest rates aggressively, and for Jerome Powell, the Fed chairman, this week signaled they're going to have to raise rates even more because inflation isn't coming down to their 2% target. So simply put, guys, an upward sloping yield curve is economic growth. A downward sloping yield curve is signaling there is a recession coming. All right. So the key to understand about the bond market is literally how it drives the stock market. So here we can see in March 2022, the bond market really took off. And we know why, because the Federal Reserve started raising interest rates in March 2022. Okay, so as the bond market started to take off and price in these interest rate hikes, and there was a lot of rate hikes by the Fed last year. There was a quarter of a percent at the first rate hike, then 0.5%, then 0.75%, 4 times in a row. And now there was a 0.5% and a 0.25%. But now the US Central Bank is saying they're going to have to raise rates potentially by another 0.5% because inflation is actually going in the wrong direction. So how does this affect stocks? All you need to understand, the earnings of companies, the value of these earnings are used by subtracting the 10-year government bond yield. So the interest rate on a 10-year government bond adjusted for inflation is called the real rate, okay? I actually have a video on my YouTube breaking this down in a lot more detail. So watch this video if you really want to understand this. But all you need to understand is the reason the stock markets started to go down when the bond market went up is because as interest rates go up, it just means the earnings expectations of companies go down, and investors are not going to buy stocks unless they expect the earnings to be growing. So here's a prime example of just how powerful the correlation is. You see the lines on the right hand side and the left hand side? Look how perfectly correlated they are. So we can see over here when interest rates started to go up in the United States in March, we can see that the stock market on the left hand side was going down. But look what happened in June when this interest rates on the 10-year government bond hit a peak and then started to go lower. You can see the stock market started to go up. And as soon as the bond market then started to rise again, at this period here, the stock markets went down again, okay? Because the bond market was going up. But then we had a period here where the bond market went down again. And what happened? The stock market rallied, you see? And then soon as the bond market went up again, stock market went down again, okay? And then recently the bond market has gone back up again and stocks have come down again. So you can clearly see that the bond market is driving the stock markets, okay? But more importantly, what this yield curve is telling us is it's signaling that there's going to be a deep recession. This is the deepest inversion since 1981. This is what Yahoo Finance was telling us yesterday. You can see this if you go search in Google, exactly what I'm saying. The deepest recession is coming if the bond market is right. And the bond market has predicted recessions throughout history. So the easiest way to understand the bond market is interest rates on government bonds up to 2 years are predicting where interest rates are going by the US Central Bank. So these are called short-term interest rates, okay, in the bond market. Interest rates above 2 years on government bonds, so 3, 5, 7, 10, 20 years, these are dictated by the market's expectations for where economic growth is going to be. All right, you're hearing the news all the time. The 2-year bond yield has gone up by 25 basis points or whatever. And that's because the 2-year yield and all these bond yields below the 2-year are literally pricing in what the central bank is doing with its interest rate. Beyond 2 years, this is the market's expectation for economic growth. Now remember, if the economy is not growing, the stock market is not going higher. No investor is going to be buying stocks in an environment where companies are not making more money and growing their earnings. The only reason a stock goes up in value is because the company continues to grow their earnings. The moment a company can't grow their earnings, the stock plummets because everyone pulls their money out of that company and takes their profits quickly. All right. So the reason why the 10-year is below the 2-year, and this is really what you want to pay attention to, is the 2 and the 10-year spread. So the difference between the two is telling you what are investors expecting for economic growth moving forward. So the reason why the US 10-year is below the 2-year is because they're not expecting inflation And the reason you wouldn't expect inflation is because you wouldn't expect economic growth. And if you don't expect economic growth, then what happens to company earnings? They're obviously going lower. That's why the stock market looks at the bond market as a signal to know if there's going to be growth or contraction, and then investors position themselves in stocks based on that expectation. So the bond market and the yield curve is literally the key driver you need to understand if you want to start trading the markets, okay? Because if we look here in September 2011, when the yield curve was upward sloping, and we go look at the stock market at September 2011, you will see that at that period of time, the stock market was going up. So September 2011, here we go, look, the stock market was on its way into a recovery. So you can see at that time, the stock market was moving higher in the United States. All right, so what's going to happen now with the bond market is all going to be down to what happens next tomorrow with the non-farm payrolls number, because the Fed is watching this data to understand what's happening in the US economy. So here's our spreadsheet looking at the US economy that me and the members use, well, the course members that is, to understand what's happening in the United States. And what they're looking to see is tomorrow, is that unemployment rate going to be going up? That's what the Fed wants to see. Are wages coming down? And then will that feed into next week's core inflation number coming back towards their 2% target? And if it doesn't, then we know what's going to happen. The markets are going to continue to price in even more rate hikes by the US Central Bank. Okay, and if rates keep going up, stocks keep going down. As I've already shown you in this correlation between the two, stocks don't perform well in an environment where the bond market keeps pricing in higher interest rates. So this is the key to the stock market. It's key to understanding how to trade currencies. It's key to training how to understand how to trade stocks and crypto. It covers everything. And if you want to learn how it affects the currency markets, watch this video in more detail. All right, everyone. So I hope that makes sense. Let me know how you've enjoyed this video, and let's see what happens with the bond market. And will it predict the recession that it is predicting, and what will happen with stocks? Interesting times.